Tonight, we're going out front with a story that's making headlines across the globe and could impact your wallet, your travel plans, and even the price of your morning coffee. This is a story that affects everyone, from the high-powered traders on Wall Street to families shopping on Main Street in small towns across America. No matter where you live or what you do, the value of the US dollar touches your life in ways you might not even realize. The US dollar, which has long been considered the bedrock of the global economy and a symbol of financial stability, is now facing its worst week in 4 months. This comes as a surprise to many, especially since it had just reached a 6-month high not long ago. The sudden reversal has left investors and everyday Americans alike wondering what's behind this dramatic shift. So, what does a falling dollar actually mean for you and for the world? In simple terms, it means the dollar's value is dropping compared to other major currencies like the Japanese yen and the euro. This shift can have ripple effects that reach far beyond the trading floors. The US dollar index, which measures the dollar's strength against a basket of other important currencies, has now slipped below the key 100 mark, a psychological and financial threshold that many experts watch closely. This drop signals a loss of confidence and can trigger further volatility in global markets. With US markets closed for Thanksgiving, trading volumes are thin, which means even small moves can look much bigger than they really are. This holiday lull is making the dollar's drop appear even more dramatic, catching the attention of investors and analysts worldwide. But this isn't just a Wall Street issue or something that only economists care about. The value of the dollar has a direct impact on everyday life for millions of Americans and people around the world. For example, when the dollar weakens, the price of imported goods at your local grocery store can go up, making everyday items more expensive. If you're planning an international trip, you might find that your money doesn't go as far as it used to, raising the cost of travel. American companies that do business overseas also feel the impact. Their profits can shrink when the dollar falls, which can affect jobs, wages, and even the stock market back home. So, whether you're shopping for electronics, booking a flight, or investing for your future, a weaker dollar can mean you're paying more and getting less. It's a change that can hit your wallet in unexpected ways. That's why understanding why the dollar is stumbling right now is so important. It's the first step to making smart decisions and protecting your finances in uncertain times. The next few weeks could be critical, not just for the US, but for the entire global economy. What happens to the dollar now could set the tone for markets and economies around the world. So, let's break down what's driving this sudden shift, what it means for you, and what to watch for as the story unfolds. At the heart of the dollar's recent weakness lies a powerful force: expectations about what the U.S. Federal Reserve will do next. The Fed, as America's central bank, has an outsized influence on global finance, and its decisions ripple through markets everywhere. The U.S. Federal Reserve is the institution everyone is watching. Its policies set the tone for borrowing, lending, and investing, not just in the U.S., but around the world. The Fed controls the federal funds rate, the key interest rate that banks charge each other for overnight loans. This rate acts as a benchmark for everything from mortgages to business loans, affecting millions of people and companies. When the Fed cuts rates, borrowing becomes cheaper for everyone. That means consumers can get lower rates on car loans and mortgages, and businesses can finance expansion at a lower cost. This often stimulates economic activity, especially when growth is sluggish. Right now, financial markets are betting big that the Fed will cut rates soon, possibly as early as December. Investors are closely analyzing every economic report and Fed statement for clues. Traders see an 85% chance of a rate cut, and many expect a series of cuts to follow through 2026. This anticipation is driving major moves in stocks, bonds, and currencies. Why is this happening? Inflation, which soared in recent years, is finally cooling off. At the same time, economic growth is slowing, giving the Fed more flexibility to lower rates without risking runaway prices. Lower interest rates make the US dollar less attractive to global investors, who are always searching for the best returns. When rates fall, investors often shift their money to countries offering higher yields. As investors sell dollars to buy other currencies, the value of the dollar drops. This can make US exports more competitive, but it also means Americans pay more for imports. It's a global chase for yield, and right now, some of the best returns may be found outside the US. This dynamic is reshaping investment flows and currency values worldwide. The expectation of lower rates is the main force pushing the dollar down, and it's a trend that could continue if the Fed follows through. The market is watching the Fed's every move, knowing that even a hint of a change in policy can send shockwaves through global markets. The next decision from the Fed could reshape the entire currency landscape, affecting economies and investors around the world for years to come. Politics are adding fuel to the dollar's decline. President Trump has loudly called for lower interest rates, arguing it helps U.S. businesses and makes exports more competitive. A weaker dollar means American goods are cheaper abroad, boosting sales and jobs. Trump's pressure on the Fed creates expectations that rate cuts are coming, even if the Fed is supposed to be independent. Investors are betting the Fed will eventually give in, which accelerates the dollar's fall. There's also talk that Trump could nominate a Fed chair who supports lower rates, raising concerns about the Fed's independence. If the central bank is seen as less independent, the dollar could weaken further. Political pressure and speculation about Fed leadership are making markets even more volatile. The intersection of politics and policy is now a key driver of the dollar's fate. As the dollar stumbles, other currencies are rallying. Investors are shifting money into currencies where central banks are fighting inflation, or where economies are improving. The Japanese yen, Australian dollar, and New Zealand dollar are among the biggest winners. The euro and Swiss franc are also in focus, though their moves are shaped by Europe's geopolitical tensions. Major banks are now advising clients to favor the euro and Aussie over the dollar. Not everyone thinks the dollar's decline will last, but the shift in sentiment is real. This global rebalancing is creating big swings in currency markets. The world is rethinking where the best opportunities lie. One of the most dramatic turnarounds in global finance right now is the Japanese yen, a currency that has long been seen as a symbol of stability, but also stagnation. After years of persistent weakness and being overshadowed by the US dollar, the yen is suddenly surging as Japan's central bank signals a major policy shift that's catching the world's attention. The Bank of Japan, which for decades was known for its ultra-low interest rates and reluctance to tighten policy, is now hinting at the possibility of rate hikes to combat rising inflation, a move that would have been unthinkable just a year ago. Traders and analysts are now betting on a possible rate hike as soon as December, marking a huge change for Japan and sending ripples through global markets. Higher rates make the yen more attractive to investors, especially as U.S. rates are expected to fall in the coming months, narrowing the gap between the two economies. The interest rate gap between the U.S. and Japan, which has driven money out of the yen for years, is finally closing. Investors are now moving billions into yen, seeking both safety and opportunity. For months, there was speculation about whether the Japanese government would intervene directly to support the yen. But now, the central bank's words alone, its hints and signals, are enough to drive a powerful rally. The yen's comeback is a vivid reminder of how quickly central bank signals can move markets, shifting sentiment almost overnight and changing the direction of global capital flows. Japan's shift is now changing the global currency conversation, forcing investors and policymakers everywhere to rethink their strategies. Investors around the world are watching every statement from Tokyo, parsing each word for clues about what comes next. The yen's newfound strength is now a key story in the currency world, with its moves making headlines and influencing other markets. In the end, central bank credibility is proving more powerful than direct intervention, showing that sometimes words and policy signals can move markets even more than money itself. Down under, the New Zealand and Australian dollars are making headlines. The Kiwi dollar jumped after New Zealand's central bank signaled it's done cutting rates and might even hike in the future. This surprise shift made the Kiwi a hot pick for investors. In Australia, inflation is running hotter than expected, so the Reserve Bank is likely to keep rates high. The Aussie dollar is now the highest-yielding major currency, attracting global investors. Both currencies are benefiting from the expectation that their rate-cutting cycles are over. For investors seeking higher returns, the Kiwi and Aussie are suddenly in demand. Analysts say both may be undervalued, with more room to climb. As the US dollar weakens, these currencies are poised to keep rising. Central bank signals are driving the action. Geopolitics are also moving currencies, especially in Europe. Hopes for peace talks in Ukraine are lifting the euro, which has struggled under the weight of war and energy crises. A peace deal could boost Europe's economy, lower energy prices, and strengthen the euro. The Swiss franc, a traditional safe haven, has surged during the conflict. If peace comes, investors may sell francs and move back into riskier assets like the euro. This peace dividend could weaken the franc and boost the euro further. Recent moves show how quickly currencies react to headlines, not just economic data. The euro and franc are reminders that global finance and politics are deeply connected. For now, uncertainty remains high, but the stakes for Europe's currencies are enormous. Every headline from Ukraine is moving the markets. So, who really controls a currency's value? The answer: central banks. By setting interest rates, they make their currency more or less attractive to investors. Higher rates draw in money, boosting the currency. Lower rates push money out. Central banks also use forward guidance, signals about future policy, to shape expectations. Sometimes, just a hint of a change can move markets as much as an actual rate hike. In rare cases, central banks intervene directly, buying or selling their own currency to influence its value. But these moves are usually temporary. Ultimately, a currency's strength reflects the health of its economy and the credibility of its central bank. Right now, central banks are the true power players in the currency game. Their decisions ripple through every corner of the global economy. So, what does all this mean for you? A weaker dollar makes imported goods more expensive. Think electronics, cars, and wine. If you're planning a trip abroad, your money won't go as far. Vacations cost more. But for U.S. exporters, a weaker dollar is good news. Their products are cheaper overseas, boosting sales and jobs. Foreign tourists also get more bang for their buck in America, helping local businesses. The dollar's value is a snapshot of the U.S. economy's place in the world. A falling dollar isn't always a crisis. It's often part of a normal cycle. For consumers, it's a good time to buy American and watch travel costs. The dollar's journey is a window into the global economy and your wallet. Stay tuned because the next move could affect us all.